Hello viewers, so today I'm in Colorado Springs. I figured the weather was so nice on my buddy's balcony that I might as well just film my first YouTube video here. The view is beautiful. I wish that could be in the background for the whole video, but I couldn't figure out how to set my camera up to do that, so y'all are just going to be looking at me for this one. So my name's Keaton Gilmer, if you didn't know. I decided I wanted to try and make a few videos to consolidate all the information I've learned since I started investing in the stock market. I realized that some of what I wanted to talk about could be a little bit confusing, so I'm going to make this more beginner video first to introduce some of the vocabulary and ideas that the investors I've learned from use. I'm about to turn 22 and I've been investing since I turned 18. I've learned quite a bit over the last 4 years, and hopefully in just a few videos I can explain most of what I've learned up to this point and all the best practices I've been lucky enough to find that work for me. I don't really want to talk about how much money I've made, but I do feel it's necessary to give at least some impression that I kind of know what I'm talking about. So since I've turned 18, my brokerage account has grown about 340%. I'm a long-term investor who picks individual companies to invest in the majority of the time, but really, that's enough about me. Let's get into this little speed tutorial. Now, this should go without saying, but if you have any debt, especially high-interest debt, like credit card debt or student loan debt, and are contemplating starting investing instead of just paying that debt off, I wouldn't recommend that. Most of the time, it would be a smarter decision to pay off your debt first and then save as much of that money that would go into those interest payments as possible. But anyways, if you're just starting out, now's probably the best time to just learn as much as you can and pay off any debt if you have any. So first off, if you didn't know, there are a ton of people in this world who would love to invest your money for you. Although I personally have never let another person invest for me, I have seen the returns from the professionally managed funds are quite subpar and seem to me almost to have just been created to generate income for the investors charging the fees. But if you're more curious about professionally managed funds, the first link down in the description is going to be Warren Buffett talking about them, so feel free to go watch that if you're interested. I've learned that really anyone can take control of their own financial future by investing if they just have the patience to learn and the patience to let their money work for them. It does take time, but it's really hard to put a price on experience. I would argue that experience is more valuable than anything you could ever learn in a YouTube video or in a book, but there's still great places to start the learning process. So, what is a stock? This is an important thing to remember. A stock is just a type of investment that represents an underlying ownership share in a company. So you're buying into a business expecting that that business will do better into the future. Each time I've forgotten this fact and invested without analyzing the underlying company, I've lost money. So once you start, you're probably going to hear S&P 500, Dow Jones, NASDAQ being discussed quite often, and those are just markets in which different company shares are traded between buyers and sellers. If the buyers are willing to pay more for the shares, the prices will increase, and if the sellers are willing to take less for those shares, then the prices will decrease. These three indexes give a pretty good idea of how the market in general is behaving, so they tend to be brought up pretty often. There are really two main ways to make money in the stock market. The first is by price appreciation, so buying low and selling high. And the second is by getting paid out dividends by the companies that have them, which is just a company paying out a portion of its profits to its shareholders. All you need to buy and sell these companies is a brokerage account. WeBull and Robinhood are both fairly good for beginners, and TD Ameritrade is a great all-around brokerage. I would recommend you do your own research on which brokerage you want to start out with, but those three are ones I've used and enjoyed, so I left a link down in the description if you're interested in checking any of those out. The stock market's average return over the past 40 years has been roughly 9.5%. I base that assumption off the returns of the S&P 500 index, but for the United States market as a whole, it's still fairly accurate. So an index is just a method of tracking the performance of a group of companies. The S&P 500 index tracks 500 of the largest companies listed on the open market. If you're interested in looking into those companies, you can just Google all holdings of the S&P 500 and it'll pop right up. One of the first things I learned about when I started was compounding interest, what Albert Einstein called the eighth wonder of the world. It's just the fact that when the interest you earn on a balance in an investment account is reinvested, earning you more interest over time. Basically, as your money grows, the return on that money grows faster and faster. Here's an example. If you invested $1,000 at a 10% rate of return per year, after year one you would have made $100, and after year two you would have made $110, and then after year three you would have made $121. This extra $10 and $21 continues to grow exponentially as your account balance increases over time. There are compounding interest calculators that show how incredible this can actually be. So if you invested that same $1,000 at a 10% yearly return, for 20 years, it would turn into $6,727 without even having to touch it. That's a return of 672%. If you're really wanting to get started investing and you don't fully understand the market yet, a good place to start is with index funds, also known as ETFs or exchange-traded funds. With these funds, you can buy all the companies in the S&P 500, for example, without needing the upfront capital to afford the S&P directly. There are also a lot of different kinds of index funds, like the ones for specific sectors, like the financial or energy industry, which are good places for beginners to start doing research and getting more comfortable looking into the future outlook of industries as a whole. Usually, the companies inside of a sector tend to trade together, meaning they each have their own standards for what qualifies a company as being good or bad. But when investing in index funds or the overall market, there is a common saying that time in the market is better than timing the market, which comes from the idea that if you were to buy and hold rather than rapidly trading in and out of companies, you would perform better over time. So with the S&P 500 from 2001 until 2020, if you had just missed the best 10 days, your returns would have gone from 7.5% per year down to 3.5%. One more thing I learned when I started investing in any way, but especially with index funds, is that it's important to not invest all your money at once, but to average into your position over a period of time. Just in case whatever you're investing in goes down in the short term, you can buy more. This is called dollar cost averaging, and every time I buy a company I do this. It's a simple concept, but I believe it helps investors make smarter and safer decisions. Okay, so that's where most people should start, and probably where some people will be completely happy with stopping, and I can totally understand. Picking individual stocks is what the rest of this video is going to be about, and it's exceedingly more difficult and time-consuming than passively investing in index funds. One of the most important things I've learned about individual stock picking is that emotions are the biggest killer of returns. In other words, you're going to be your own worst enemy. This is because you must stay very calm and collected, and you can't jump to any big conclusions. You have to be okay at times with the stock price of the companies you own going down. Here's a clip of Warren Buffett explaining this.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
Basically, you just need to have enough self-control to manage your emotions. Remember, you don't lose money on an investment until you sell it. You have to be confident in your own decisions and understand all the risks you're taking on with each of the companies you choose to buy into. There are a few ways you can do this. The first is by researching the fundamentals of a company, which is just anything that can affect the underlying value of the company. So you really want to look into a company selling products people need and ones that have a competitive advantage in the market. An advantage can come from a special patented product or from having a high barrier of entry for new potential competitors. A brand name is also a very valuable thing when it comes to staying competitive. A company with a great brand name will always command a higher market price than a company without one. You also want to gauge the financial health of a potential investment. A healthy company will have a large amount of assets compared to a smaller amount of debts. It would also have growing profitability and a large total addressable market, or TAM for short. All of this can be found by looking at a company's financial statements, like the balance sheet, income statement, and cash flow statement, which are all on a company's investor relations page on their website, along with a lot of other valuable information. These financial statements can also be used to calculate the intrinsic value or current value of a company, which can help you know if you're getting a good price for your stock or not. I'll explain how I do this in my next video, but it's key to only buy a company when you know you're getting a good deal. There are quite a few more things you can investigate to ensure you're making a smart decision, but I'll talk about a few of them in the next video, but I'm really only going to speak about the things that I know and I use. Another form of research is technical analysis, which is just looking into a company's stock chart to see its historical performance, which can provide a little information, but definitely not enough to make a complete judgment on the value or direction of a company. Another type of analysis I like to combine with technical analysis is called behavioral analysis, and it's just understanding that people are the ones buying and selling stocks, dictating the stock price. People have a tendency to overreact and underreact, which allows for a lot of the opportunities I find in the market. Ideally, each of these strategies will be used to evaluate different aspects of a company, and combined together, they can help you make an informed decision on the future direction of that business. I know this might sound like a lot of work, and it can be a struggle to find all the important information you need sometimes, but it is truly the only way I've been able to find to beat the market consistently. And remember, due to compounding interest, just by beating the stock market's average returns by a few percent could relate to much larger returns in the future. For example, Warren Buffett is arguably the best investor of all time, and he's achieved an average annual return of around 20% for the past 56 years. An investment of $1,000 at a 20% rate of return equals $38,300 after 20 years. That's way more than the $6,700 at the 10% return. Granted, I wouldn't expect to be as good as Warren Buffett, but it does prove that beating the market is possible, and for me, that's really all the proof I need. So your first question is probably going to be, well, where can I find great companies to invest in? And when you're just starting out, you probably need to stick to looking into larger companies with proven business models that are steadily growing. These will usually be easier to research. Think Apple, Amazon, Facebook, Google. But really the most important part is you're just looking into companies in which you can understand how they make their money, or you use their products and services and find them to be particularly good. Listening to other people's investment advice can be useful and a great way to learn about new companies, or even just improve your own investment strategy. But it's crucial that you only invest based on the research you've done and because you believe in a company, not because someone else told you it would be a good investment. The first reason is because likely you end up losing money on whatever that investment is, and the second is because you're missing out on the opportunity to test your research and analysis skills. A great quote by Edgar Allan Poe is, "Trust nothing you hear and only half of what you see." To invest in a company, it must prove to you that it is undervalued or has some potential for growth. Just because someone else sees an opportunity doesn't mean you will, and vice versa. If you find a good investment, others might not agree with you. It's important to listen closely when people disagree with you, but you have to understand different people invest in different ways. There's not one way that fits everyone, and different people have different risk tolerances and varying levels of knowledge that they choose to invest with, and you have to take that into account when you're listening to their advice. One last thing I want to mention is about taxes. I didn't really understand them when I got started, so it made filing my taxes a little bit more confusing. Capital gains is just the profits you make on the sale of an asset. You can get taxed in two ways on capital gains. The first is long-term capital gains tax, which you pay on a company you've held for over 1 year, and short-term capital gains tax is paid on profits you've taken in less than a year. Short-term capital gains tax is taxed at your normal income tax rate, but long-term capital gains is paid at 0, 15, or 20% based on your income tax bracket. Some states do have their own capital gains tax. I live in Texas, so we don't, but I recommend you look into that wherever you live and make sure you know exactly what you're getting into. I'm also not a CPA or financial advisor, so you should definitely look up all this information if you can. I know I talked really fast about a lot of things, so if you're interested in starting investing, you're probably wondering how much should you invest, and the only tip I can give for that is only invest as much as you're willing to lose, because it does take time to make money, and in that time you're bound to lose some. Warren Buffett's #1 rule when investing is never lose money, and his second rule is never forget the first rule. Now, I still lose money on occasion, and I'm absolutely okay with holding a good company that falls 20 or 30% if I believe it'll grow in the future. But the only real way to ensure that you don't lose money, or at least make more money than you lose over time, is to manage your risk while investing. And in my next video, that's all I'm going to discuss. Thank you guys for watching this video. I know it isn't everything you need to get started, but I hope it gave you a little bit of direction, and in my next few videos, I'll elaborate even further. If you do have any questions, I would love to answer them in the comments, and also I left a lot of good tools and information in the description for y'all to check out. But alright, that's it guys. Later.